my wife, when she started getting Social Security, she found out she had an IRA from a job she had way back in the early 90s. And we were blessed with about $17,000. And I was wondering about investing. I was looking at the recommendations and wondering if I should maybe divide that up into some preferred stock. I know there's one preferred stock that was recommended, and then maybe the CD ladders. We're both over 65, so I was just going to, do something relatively non-risky.
Conservative, right. Well,
Yeah.
I'll preface that with saying that every single investment has risk. It's just a matter of which kind of risk you're comfortable with. The fixed income type investments have interest rate risk. So, as rates go up, as they have been, that's why you saw last year there was really no place to hide. The S&P was down 19%. The NASDAQ was down 33%. Bonds were down 15 to 20% as interest rates started to rise. My recommendation is always to have a diversified portfolio, because if you pull up a chart of the best performing asset classes going back 10, 20, 30, 40 years, every year there's something different at the top. And if you're always investing in the things that are most popular, then you're probably going to fare pretty poorly in overall performance, because it's the things rotate in and out of favor as economic conditions change. Now, what I would say is that if you do have a fairly conservative outlook, preferred stocks are still stocks. They can still change in value. Those companies can still default and different things like that. So there is some risk associated there. If you don't have a high risk tolerance level and you want to stick to the fixed income type investing, you're probably better off staying with the I bonds, the CDs, and things like that. You just have to be aware that you're most likely not going to get any growth in your principal. So you said you're over 65. I don't know how much over 65 you are, but even if you're around that 65-year-old age, you still have, statistically speaking, you still have a pretty long lifespan ahead of you. So if it depends on the amount of money you have set aside, because if you're in fixed income, let's say that you have a pension, you're probably not getting cost of living adjustments there. Your purchasing power is going to start to erode. If you're in inflation protected bonds and things like that, you're probably going to keep up with inflation a little bit. So you really have to consider whether or not you're going to need to grow the investments that you have to make them last for as long as you need them to last. And then, the most important thing is just to consider, do you have the ability to stick with it if you experience temporary or even prolonged decreases in the value of your investments? But if you have a lower risk tolerance, you have to settle into those types of investments that don't have market risk, but don't have the potential for growth either. So you have to make sure that you set your expectations according to the risk that you're willing to take.